Welcome. I'm Paul Archowski. I'm here today with Michael Moskal and Scott Lipa, do our periodic update to the stock market as we head into the fourth quarter of 2022. And with that, I'm going to turn it over to Michael.
Thank you, Paul. And no doubt it's been a painful year for investors. The stock market as well as the bond market have seen some downs this year. We would attribute much of that to what the Federal Reserve is doing in their policy. From 2009 to 2021, I have the picture here of Jay Powell with his money guns, printing money and keeping interest rates at zero had a very positive effect on the economy, stock market, bond market, and real estate. As we know, anybody who owns a house knows that house prices have gone up quite a bit also. And now you have the Jay Powell pulling his hair out because the Fed has been in a situation where inflation has been very high. And one way to get inflation down is to raise interest rates and slow the economy down a bit and to stop money printing. So we're in a much different position right now in the markets than we have been. We know it's been painful again. As we look at returns through September 30th, we see a lot of negatives on here in the stock market, bond market. Some positives though, we have seen a turnaround in October. Got some positive numbers for the stock market. The bond market's still sort of sitting down negative. And look at the last 10 years again, even with today, even what's going on with this year, the last 10 years has been very favorable for investors. As we look down the chart, the traditional 40 or 60-40 investor, 60% of that's equity, has made 9% a year for the last 10 years. So if you've been an investor, even with the painful year we've had this year, still looking at returns 9%, 10, 11%.
Michael, a couple of things that stick out to me on this slide is the 10-year return on the MSCI, the foreign market index, and the idea that eventually a pendulum swings the other way and you return to a mean. So, what sort of values I wonder or think about what sort of values are there in the foreign markets, and as that pendulum swings back the other way, what we can take advantage of there. The other thing that sticks out to me is there was really, through September, has been nowhere to hide in 2022. When you look at aggregate bond returns down 15 and 7 to 10 year government bonds down 16, people traditionally think of those as their safer investments, and to see double-digit losses as the Fed raises rates is something that people aren't accustomed to and haven't seen in years.
Yeah, that's probably the biggest story this year, Scott, because usually, and you can go back for 100 years, and the correlation is very high. Usually when the stock market goes down, you're going to have some positive results in fixed income, because usually people are, if they're taking money out of stocks, they're putting it in fixed income. So like you said, this year we've not have that. And that situation, actually, you can go back to, it's well over 100 years since the last time we've had that situation. Bonds are having some of the worst year they've had in 50 years. Now, there's a flip side to that, because there's opportunities now that have not been around for probably 15 years in the fixed income market. We're buying for clients now fixed income, individual fixed income, bond ladders that are in the yield of 4 to 5%, right? And the first time we've seen that in 15 years. Before this year, we were looking at yields of less than 1%, in fixed income. So it has opened up some great opportunities, which we are taking advantage of for our clients. A couple items on market declines. Some people call them bear markets. They've always been temporary. This chart will show you going back to 1928. That red line that you see is the stock market. That's the S&P 500. And over time, it goes up. It doesn't go up in necessarily a straight line, though. As we see some of those blue vertical lines that you see there, those are bear markets that happen. And on average, over time, about every 4.5 years or so, we're going to have a bear market. Now, we haven't had one since 2009, so this time period was a little bit longer. But on average, every 4.5 years or so, we're going to have one of those blue horizontal lines that pop up in there. And but after every bear market, the market has gone on to hit new highs. So there's no reason why we feel this isn't going to be that same way now. We'll be looking out 10 years from now, and that red line will be even higher and off the chart here.
And I'm wondering, Michael, if the worst of this, you mentioned some bear market statistics, but I'm wondering if the worst of it is behind us, in meaning that maybe we're already 10 months into a bear market that's typically 12 to 24 months, and we're already down 25 to 30% off of highs, and the average bear market is 30-35% to the downside. So maybe there is light at the end of the tunnel, and maybe we're further along in this than people realize or than people consider. And the opportunity that it creates right now with what we're doing with some of our stock side, where we're seeing the tech side of the market down 40, 45, some of these stocks at 2-year lows. What an opportunity to buy into these stocks that were just bid up over the last couple of years, and take some of the gains from the stuff that we hold that what we call is inflationary friendly, that has held up well, like consumer durables, going to the grocery store, energy, which is gas prices, taking some gains from there and taking advantage of what we've seen the first 9 months of the year.
Yeah, absolutely. And Scott, you're right, because the average bear market lasts 289 days, which is about 9.5 months or so. And that's the average. So we're right around pretty close to average at this point in time. And so perhaps we're getting to that point where we're going to start seeing some rallies. And, I do have to say with our portfolios, our portfolios have done much, much better than the stock market has this year. So if you're talking about the stock market being down 25%, even our more aggressive portfolios are down, much, much less than that. I think on average, we talked about our client portfolios, growth portfolio on average for us is, maybe down this year 12 to 14%, something in that range. And, we hate to see downs. I'd like to never see downs. It'd be great never to have any negatives, but we know that's not going to be the case over time. But, our portfolios have done well. And what that really means is that we just have much less to make back to even. So that's a good thing for us. What should you do during down stock markets? Certainly don't panic. During prior bear markets, we have seen people, they just panic a little bit. And it's understandable, by the way, when they get a statement, they see some negative numbers on there and negative dollar numbers on there. It's hard to want to stick to your plan. What is it Mike Tyson says? Everybody has a plan until they get punched in the face or something like that. Mike Tyson said that. So yeah. The punch in the face for investors is seeing negative numbers. But, it is really important to don't panic, especially if you have a long-term plan in place. Like most of our personal wealth clients, we have, long-term plans in place for them. You got to kind of stretch out and say, yeah, it's been not a good 10 months. Well, let's stretch that out over the next 5 years. Let's stretch it out 7 years, 10 years. Also don't try to time the market. We do get occasional questions from people saying, what if I just take my money out now? And then when it goes back, it's going up, we'll put it back in. That's called timing the market. Over long periods of time, it's proven not to work. If you look at this chart goes back from 2001 to 2020. That's a 20-year time period. The S&P 500 index did a 7.5% return over that time period. If you just were out of the 10 best days during that time period, you're talking about 20 years. If you were out during the best 10 days, your return fell to 3.4%. If you were out the 20 days, it's about even. And 30 days over a 20-year time period, you actually get into negative returns. And the reason that is, by the way, is because the very time to want to be buying stocks, and we were talking to Scott, you just mentioned that, right? The very time to be wanting to buy stocks or buy certain sectors that have gone down the most is when it doesn't feel like it. When it doesn't feel right, when it feels like the worst time to be buying, that's usually the best time. And the best time to sell is usually in the time when everyone wants to be there. So trying to jump in and out of the market has proven not to work over time.
What Buffett say? Be greedy when others are fearful, and fearful when others are greedy.
Yes. Yep. Exactly.
So I'd add one more thing on here. You have number one, number two, number three. I would add would be don't open your September 30th statements if it's going to bother you that much. Let us worry about where you're allocated and what we're doing on the stock side to take advantage of this.
Yeah, if you don't have to, there's really no reason to, because it's just a snapshot in time. And like we had in the returns for this year, if you look at your September 30th, you're better off already now anyway. The market's gone up just for half the month. In October, the market's gone up. So you already made gains that are not reflected on that 9/30 statement.
And I think another point to make is that those losses that if you're seeing a September 30th statement and your account's down, that's just a loss on paper, unless you do what Michael's saying, like unless you time the market and try to get out and actually realize that loss. It's nothing more than a paper loss. You still own all the shares of all the stocks or bonds that you held previously. the prices have just come down, but we know that prices always rebound over time.
Yep. And the only reason they wouldn't, by the way, because I've had this question occasionally from people that say, why wouldn't stocks go up over time? And you got to remember that all stocks are ownership in corporations in the United States of America, right? So public companies, so we would have to have the economy and companies globally, like the aggregate in the U.S. not do well, over a long period of time. If that's happening, that means the country's falling apart, in which case you're not care about your stock prices anyway.
Right.
But, we don't see that happening, of course. We think, this country is still in very great shape. It's still the best country to be in the world. You don't see people moving to China. People want to move to the U.S. So we're still in a position we think that over time, the country does well, corporations do well, they make profits, which means stock prices go up over time. I'm going to read one more, Scott. I like the Warren Buffett, about buying when others are fearful. This is another one from John Templeton. And John Templeton was one of my personal idols back in, when I started back in the 1980s. He was just about winding his career up back then, but I got a chance to talk to him a couple times during that time period. But he said, to buy when others are despondently selling and to sell when others are avidly buying requires the greatest fortitude and pays the greatest ultimate rewards. And, he said many things like that because he also felt like we did, of course, that, he wanted to be buying when everyone else was trying to dump out of the market. He wanted to buy at lower prices. And then if he was going to sell something, he was going to sell when everybody wanted it. He was going to sell it to them, and buy it, sell at a high price. He wrote that or said that, by the way, in August of 1958. So what is
obviously
that?
Worked for him.
Yeah, 65 years ago, he said that. It still holds true today, right? The same principles back then are the principles today. Like it or not, the Federal Reserve in this country is sort of driving the show when it comes to asset prices. And, and there's two reasons why. One is they have a printing press that they can just print. And I'll add, without accountability. The Fed they're not elected. The Fed officials are not elected. Chairman Jay Powell is not an elected official. He is appointed and he does get renominated by the president and Congress, but they're not up for election. So they kind of have a lot of power and a lot of freedom, and they have a printing press that they can just print money. And they don't technically print money anymore. They push buttons on the computer to make it go from one place to another. But, the Fed can print money, and they also control interest rates, the price of money. So, to reiterate what we said at the beginning, when the Fed cuts rates and prints a lot of money, it has a pushing up effect. It supports asset prices. It supports stocks and bonds and real estate. And it also supports the economy. And when they do just the opposite, when they start pulling back on money printing and when they start raising rates, it has the opposite effect of it pushes asset prices down, and it has a drag on the economy. And right now, you see on this chart, the Fed really has a decision to make. Do they go after high inflation, which means raising interest rates and stopping money printing, or do they try to avoid recession, which means lowering interest rates and printing money? And right now, they've been on this path of higher rates and try to attack inflation, which is probably the right thing to do. Because the population in general, there's a lot of people out there that are living on paycheck to paycheck, and high inflation affects them much more than does a down stock market.
Yeah, I think everybody's afraid of recessions, and you hear a lot of negatives, and a lot of people haven't been through one recently, so it's scary. But recessions are part of the normal cycle of the markets, just like a bear market happens every 4.5 years. You're going to have recessions happen periodically too, and it's just a way for the market to reset and kind of weed out the weak companies and prepare for the next string of growth. So it's a normal healthy part of the market cycle, and it's something that you just prepare for it, you ride through it, and overall the market keeps going up over time.
Yeah, that's a great point, Paul, because any economic system, especially our quote unquote capitalist system, it's going to have its ups and downs. You can't have that. You can't have all ups. Just like I can't stay up all the time and get, I'd like to do it, right? We get a lot done if we just stay up and never sleep. But our down cycle for humans is when we go to sleep at night and we got to refresh ourselves. And then we're able to get up the next day and go at it again. So economies, investment markets are just sort of reflective of the human cycle, where every now and again, you got to have a down cycle. That's sort of a resting cycle, a resting period that does weed out the weak. There's a lot of what are called zombie corporations out there right now that have been supported by, a lot of the money printing that's gone on that probably don't belong in business. If a corporation is not run the right way, then probably it should go out of business. And then you open up opportunities for other companies to step in that are run better. So that's just part of the cycles that happen. This is a good news. I think so, right? This is good news. Market valuations, as far as how expensive or how inexpensive that stock prices are, have come down quite a lot, in this year. So we kind of got to levels that we never really saw before. Very, 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 very expensive levels. This particular chart is called the Buffett indicator. And this is just the value of all public corporate equities divided by GDP, by GDP, total GDP, the value of our economy. And you get a ratio, you get a numerator, a denominator, and a ratio. That ratio got to levels that we really never saw before. So stocks did get pretty pricey. We've come down a long way, which is good. Do we have more to go? Maybe. We'll see what happens. But we have gone down quite a bit. And that means stocks like Scott, you referenced, tech stocks, they've come down quite a bit. And so, buying somewhere in here like we are going to do, we're going to be doing that, soon. Certainly we're not buying at the highest prices that are out there. We're buying at, much discounted prices. A couple things, looking at the outlook for the fourth quarter and beyond. Fourth quarters have been very kind to the stock market over time. I have numbers on here since 1928, and the fourth quarter has been the best quarter for the stock market on average. Why is that? There's a lot of that has to do with sort of the psychological effect of the fourth quarter, what's going on. It tends to be a happy period for many people. You have Thanksgiving going on, you have Hanukkah, Christmas, other holidays going on that tend to be happy times for people. I have a picture of Santa Claus on here. There's something called the Santa Claus rally, which has a 77% chance of the stock market being up during the 5 days between Christmas and New Year's. And that goes back a long way. So there's sort of this happy time period. So we think we'll maybe see that, this fourth quarter. We'll probably need something from the Fed during that time period. We need the Fed probably to come out and at least signal that maybe they have a pause coming up with raising interest rates. Probably they're not going to come out and say they're going to end rate hikes, but at least coming out and saying maybe they'll be taking a pause at some point.
Yeah.
The
Santa Claus rally is a real thing. Never underestimate the American consumer. If you have the money to spend, people will spend it. And then on that last slide, if you want to go back for a second, Michael, the one the Fed pausing, I think the Fed is being very reactionary with this, and the tendency is for them to overshoot a little bit. So I agree with you. I would like to see them, just because you raise interest rates today doesn't mean the money comes out of the economy and slows things down tomorrow. It takes time for these things to play out, and you'd like to see the Fed pause and let this play out before they continue with additional rate hikes.
Yeah, they probably don't want to politically. They don't want to really make a change in policy before the elections, which I think are only 3 weeks away, I think.
Yep.
So they're probably not going to do anything that's going to cause suspicion that they're trying to sway an election one way or another, before the election. So we may see them though after the election come out and say something, that they know they've hiked rates a lot this year, arguably maybe the most ever in a short period of time, and that maybe a pause may be warranted somewhere. For 2023, there is an election year cycle that really favors gains in 2023, or at least better performance. Looking back to 1928, that third year in the presidential term, which is 2023, has by far outperformed all of the other years that are in that 4-year cycle. Why is that? Well, typically that third year, you start getting the politicians start thinking about election coming up in that fourth year, and they want to start trying to juice up the economy, make things look better. So that third year, you tend to find Congress start talking about passing legislation to make things look better. And they put pressure on usually the central banks to help them to that end. So we do expect to see something. Again, 12%, we don't know. Okay. But we tend to see something better than what we've seen maybe this year.
Right. You figure Americans vote with their pocketbooks. And that goes for, if you feel good about your financial situation come election time, the incumbent probably has a much better chance of being reelected. Same with the economy. If the economy feels like things are getting better and inflation's coming down, people will tend to vote for incumbents rather than the other. So what I think you'll hear a lot more of, like you're saying, Michael, is more inflation protection acts and student loan forgiveness and gas tax holidays and just different things that politicians can do or policies they can enact that will stimulate the economy next year.
Yeah, and Scott, you had something you mentioned before, not during this call, but you mentioned it before about the stock market being down during that third year, and then what the subsequent returns are. You want to?
So when the first half of the year is down in a midterm election year, the average downturn is about 16-17%, which we're past already now. But what I thought was really interesting is that the following 12 months after a midterm election, the return of the market averages since the 1950s positive 37%. It's just, that seems crazy, but it goes back to the idea of these things we're talking about, the policy changes that can be enacted that can push money into the economy. And it's also a good signal, I think, for people that, right now the market is down and it doesn't feel good, but the idea of giving up on the market now or selling off now because you feel like you've done something, you'd miss out on that average of 37%. Now, obviously we're not saying the market's going to be up 37% over the next 12 months, but eventually, history tells us that the likelihood of a positive 12 months following a midterm election, the probability is very good.
Yeah, especially when you're down. That's just logic. If you go down a lot, at some point you're going to come back and be up a lot. That's the way the markets work. So yeah, we don't know. Right, you're right. We don't know whether it's 37%, but if we there's a lot of bad news out there right now. So at some point in time, you get rid of the bad news and you start having at least some good news in there, which is gonna be favorable for asset prices. All right, last comment. We do acknowledge it's been a painful year. We hate seeing years like this, even though we know we're going to get them. Again, on average, every 4.5 years, we're going to get years like this. We don't know exactly when they're going to happen. That's the average. So sometimes you go through 6 years before you have years like this, sometimes 2 years. But, it's never fun for anybody. Investors, it's not fun for us either. But we do try to look for opportunities. And again, right now we're looking for opportunities that we're finding in the fixed income markets, able to get higher rates of return on new money going into fixed income. Like we said, we're able to get 1-year CDs, bond ladders, which are in corporate bonds, in the 4 to 5% range for investors, which is great. And then in stocks, there's certain stock sectors that have sold off, like Scott mentioned before, that have sold off tremendously. That probably is not a bad time to start nibbling in those areas. So those are all ways that we're looking at in order to enhance your returns as investors.
Well, it's hard to believe, Michael, that we're talking about 4.5% as a great fixed income rate, but relative to what we've seen the past few years, it's considerable.
It's been a long time.
It's been a long time, and this is great. It was a great opportunity for retirees or those nearing retirement that want that conservative piece of their portfolio, and now it actually generates some sort of yield, which is great. So something we haven't seen, and it's good for investors or retirees especially.
Yeah, when we mentioned 4.5 to 5% on a fixed basis, and some of those are guaranteed. If you're buying treasuries or agencies, which are government agencies like Freddie Mac, Fannie Mae, or CDs that are FDIC insured, we're still getting 4 to 5%. So those are guaranteed, by the government. But we're comparing those to the 0% rates that we've been used to seeing, in savings accounts, bank accounts, CDs over the last 10 years. So yes, that's much, much higher than what we've been used to seeing.
Yeah, it really lets us get the target returns without having as much volatility in the accounts by putting more of the money in safer investments.
Yeah, it gets us back to what it used to be. For older investors, it's been a real challenge to try and generate a 7% return or whatever the goal may be without having a lot of money in the stock market the last 10 years. When you're earning almost zero on your fixed income, you just have to have a lot of money in the stock market. But getting 4 or 5% in that fixed income just means, like Paul just said, that we can take less risk. Have less money at risk in more risky parts of the stock market. Okay.
Yeah.
Paul, any final comments, Paul?
We just want to thank you for joining us, and we always appreciate any feedback, comments that you have, if these are helpful updates. And other than that, have a good rest of the year, and we'll probably see you again early next year. Thank you.
So long.